Hello and welcome. This is Professor Spark, and today I'm going to walk you through selected topics of Chapter 9. Just to remind you, these ACC sessions focus on only selected topics, so you are responsible for learning all the material from this chapter. I encourage you to take notes from the whole chapter and seek help if you need it. Also to complete all the coursework, and in addition to completing the required coursework, to go ahead and self-quiz from this chapter too. Chapter 9 is all about current liabilities. The topics we're going to focus on in this ACC session are sales tax payable, unearned liabilities, notes payable, warranties, and uncertain liabilities. The good news is that a lot of the stuff that we learn in Chapter 7 will apply to this chapter. Okay, so we focused on notes receivable in Chapter 7. A lot of those same topics will come back in Chapter 9. All right. Real quick, just to talk about the difference between current versus long-term. Usually the cutoff between a current liability and a long-term liability is 1 year. It's basically, you look at the liability, the accounts payable or the note payable, and you determine, is this owed within the year or is it owed beyond 1 year? And that will be the distinguishment whether it's current or long-term. There is this language here that says or within the company's operating cycle, whichever is longer. Some companies, such as construction companies, they take longer to construct their product. So their operating cycle can be longer. It can be 18 months or so. So in those circumstances, their current liabilities would be anything that's payable within 18 months. Okay, but most companies, the majority of companies, are going to be 1 year because their operating cycles are going to be small. In this chapter, we're also introduced to uncertainty. So sometimes we have a liability that we need to record either in our financial statements or in our notes to the financial statements, and we may not know all the specifics. We may not know exactly who we're going to pay or when we're going to pay it or how much we're going to actually have to pay, but we still need to record the liability, and we'll talk about a couple different types of uncertain liabilities today. We're also going to focus on known liabilities. Accounts payable, I'll let you read about, but that's a refresher. We will talk about sales tax payable. We will also refresh you on unearned revenues, and we will focus on short-term notes payable. I want to tell you that payroll liabilities will not be covered. So all the pages that talk about payroll taxes and withholdings, you can skip all that coverage. And then just a touch on multi-period known liabilities. Multi-known period liabilities are going to be liabilities that are, for example, a note payable that is longer than a year. So if you've got a mortgage, for example, a mortgage note, maybe it's a 20-year note. You would classify that part as current and part as long-term. Everything up to a year will be current, and the amount that is owed beyond 1 year would be long-term. That's a multi-period known liability, and I'll let you read more about that in the chapter. Okay, first thing we're going to focus on is sales tax payable. So if you recognize the little Target symbol, let's say that we walk into Target and we make a $10 purchase. If you make a $10 purchase, you read the little tag on, I don't know, a shirt or something, and it says $10. Do you actually get to walk up to the register with a $10 bill? Is that all you're going to owe? Hopefully you're clued in to know that would not be all that you owe. You're also going to owe sales tax. And let's pretend for a moment that the sales tax is 10%. Okay? So in this example, Target would need to record the sale. We're talking about a purchase on our behalf, but Target, the company, is going to record a sale. Okay? So how much cash do we have to hand over, and how much cash is Target going to collect? Okay, they're going to collect the $10 plus a 10% sales tax. So Target is collecting cash. Cash is increasing. It increases with a debit. So they're going to collect cash of $10 plus 10% of $10, or $11. Okay, second thing you want to do is record the sale. The sale is a credit, because it's a revenue account. Revenues are always to the right. But always remember to record the sale, the actual sale price, so $10. Okay, hopefully by now you're recognizing the fact that we have a irregular journal entry here. We cannot record a journal entry with higher debits than credits. So we need one more credit for $1, and that's going to go to sales tax payable, $1. What this is this is a holding account. It's a liability, not a revenue, not an expense, but a liability. Target would collect the sales tax, and then at a certain point in time they would go ahead and remit it or pay it to the state. Okay? The other part of this entry then would be a debit to cost of goods sold and credit to merchandise inventory to record the cost of that inventory. Now I didn't give that information, so I just recorded X's here. When we remitted this money to the state, okay, what we want to do is we want to first close out this payable. Remember that payables have a normal credit balance. So if we're going to close them out, we're going to pay them. They are no longer a liability. We want to close that out, and we want to go ahead and credit cash. And if you get confused, just think about the logics of what's happening in cash. If we're making a payment to the state, we're crediting or decreasing our cash. The debit then would be sales tax payable. All right, so this is from your handout. Dextra Computing sells merchandise for $6,000 cash on September 30th. The cost of the merchandise is $3,900. The state law requires Dextra to collect 5% sales tax on every dollar of the merchandise sold. Record the entry for the $6,000 sale and its applicable sales tax. Also record the entry that shows the remittance of the 5% sale on the, or 5% tax on the sale to the state government on October 15th. Okay, so starting with the actual sale on September 30th, again, we're going to collect cash, but not just for $6,000, for $6,000 plus the 5% sales tax. So that comes to $6,300. Okay, the second part that I would do if I were the student is I would record the sale, because I know that I want that sale to be the exact amount of the sale price. Okay, now we can recognize that we're off, right? $6,300 debit, $6,000 credit. We need another $300 credit, and that's going to be our holding account sales tax payable. Okay, we also need to record cost of goods sold for $3,900 and merchandise inventory, a decrease of $3,900. Okay, so this would be recording the sale. And again, if you just keep it simple, we record sales for the selling amount, cash for the sales plus sales tax. The difference goes to sales tax payable. Now, when we remit on October 15th, what we want to do is first close out the sales tax payable and credit cash. And again, remember that you are making payment, so cash is decreasing, cash is a credit. Okay, and then you would be able to naturally say, okay, I need a debit. What am I doing? I'm closing out the payable. All right, so unearned liabilities are the next thing that we're going to do, and this should be a refresher to you. We've learned about unearned liabilities. So let's just do this journal entry, and I believe this is from your handout. Ticketmaster receives $4 million in advanced ticket sales for 4-date tour of Green Day. Record the advanced ticket sales on October 31st. Record the entry to record advanced ticket sales, and B, the revenue earned for the first concert date of November 5th, assuming it represents 1/4 of the advanced ticket sales. Now would be a good time to pause and try this on your own, or you can just follow along with me. All right, so on October 31st, this is the day that we're getting the money. So cash is going up for $4 million. You can note that there's no sales tax in this journal or in this transaction. Okay. Now what's the credit? Remember that this is to our revenue account, our unearned sales account, because we've not actually earned the money. Okay, when we collect the advanced ticket sales, we've not provided the concerts. So it's a liability, unearned sales. Now on November 5th, the date that we actually do perform one tour, now we've earned how much? We've earned $1 million, right? So how do we record that entry? Well, we know that we need to, once you earn the money, you get to record revenue. So we're going to credit our sales for $1 million. But what do we need to do with the debit? We need to close out 1/4 of this liability. Okay, so the debit to the liability shows that we're reducing this account, this database account essentially, by 1/4. Okay, and then our credit entry would be to sales. Oops. I don't know why that's not working. But here, credit entry would be to sales for $1 million. All right, we're also going to talk about notes. So again, this should feel a little bit like a review, but remember that we need to know our terminology here. So a note is something that's signed. It's more official than accounts payable. You've got the person that's promising to pay and that signs is the payor. The person that they're going to pay, American Bank, is the payee. Remember, I told you that cute little trick that my student taught me one time, that it's kind of like being the employee, right? The person that's going to, in the end, get the money, the payee. Okay, you can note that there's a number of days and an annual interest rate, and that if you can recall from Chapter 7, we have to convert that if it's less than a year. Like, for example, this is 90 days, so we're going to have to convert that into a smaller interest rate to account for the less days. So let's take oops, my goodness, I don't know what's happening here. Let's take Red Tools Inc. borrows $100,000 cash on October 1st by signing a 60-day 10% note. So first, let's determine the due date. And this is the same as we learned in Chapter 7. So we start with October 31st, the month that we sign the note. Then we take off the day that we sign it. So that means that there's 30 days left in October. And we're trying to get up to 60 days. So the next month is November. And we only need 30 days, but that happens to be the month in anyhow. So November 30th would be our due date. Okay. Now the journal entry for October 1st, the day that we borrow the money, remember what's happening here. We're increasing our cash, right? We're borrowing money, so cash is our debit for $100,000, and we're crediting notes payable for $100,000. Now notice at this point, we don't record any interest. On the day that we borrow the money, we've not actually accrued or incurred any interest expense or interest cost, right? We've just signed and we've got the cash, no interest yet. Now here we're going to go ahead and record all the interest expense on the day that we pay the note. It's a 60-day note. We're going to pay the note on November 30th. We're going to first start by closing out the payable. You need to close that out because we no longer owe it. Okay? Then you can record interest expense. And remember, the interest expense is the principal times the interest times the number of days of the note divided by 360. Okay, remember it's not 365. Bankers' rules say that we're going to compute interest on 360 days. Okay, so that amount ends up being $1,667, and we're going to go ahead and pay cash for the whole amount, $100,667. Okay. Now, if you recall, there's another adjusting entry that's needed when the note is signed and paid in a different year. So if there's a period in between, we need to record the interest earned between the day that we sign the note and the end of the period. I'm sorry, not the interest earned, but the interest expense incurred. Okay, and just a refresher on how to compute interest, remember that it's principal times the interest rate, which gives you annual interest. But if it's less than a 360-day note, we need to convert that then into the number of days. So take the number of days of the note divided by 360 equals your interest. Okay, so Red Tools Inc. borrows $100,000 cash on November 15th by signing a 60-day 10% note. On what day does the note mature? Okay, so let's start with the month that we sign the note. So November 30th minus the day that we sign it equals 15 days in November. Add in 31 days for December, which totals 46 days. Okay, remember that we need 60 days. So we're going to need 14 more days in January to equal 60 days. Our due date then would be January 14th. Now we need to figure out how much, let me back up. Because this note is being paid beyond the year end, okay, so December 31st is our year end, because payment is occurring in the next year, we need to split up how much interest expense is incurred in 2009 and how much is incurred in 2010. It's very important because GAAP rules say if we incurred the expense in 2009, even if it's not paid, we need to record it in 2009. Okay, so how many days occurred in 2009? 46 days. Okay, so 100,000 times 10% times 46 over 360 equals 1,278, and I rounded. Okay, it actually came up with some change, but I just want to keep it in whole numbers to keep things simple. How much interest expense incurred in 2010? Well, there was only 14 days in January. Okay, that was the only month that we incurred interest in the new year. So same thing, principal times interest times 14 days over 360 is 389 days. And again, I rounded. All right, so now they're asking for the journal entries on the day that we sign the note and borrow the money, the year-end entry, and payment of the note. Okay, again, these are the same principles that you learned in Chapter 7. It's just now we're talking about interest expense and notes payable. Okay, so the day that we sign the note, 11/15, we're getting cash. 100,000, you don't worry about any interest at this point, and we record the note payable. Okay, now we need an adjusting entry on December 31st. Nothing's being paid on December 31st, but GAAP rules say we have to record the interest that we actually incurred as of December 31st. So interest expense and interest payable. Okay, remember that interest gets its own separate accounts. Revenues, receivables, expense, payables. All right, so now the hard part comes on the day that we actually pay up. So January 14th, first off you want to close a note payable. Okay, remember once you settle that liability, you want to close it up. Okay, then you want to go ahead and record the interest expense, not for the whole thing, but just of the amount that was incurred in the new year. Then you want to close out the interest payable. Okay, because no longer is that owed. You don't want that showing up as a liability. You paid it up, it's not owed anymore. And then cash, you're going to pay out for the principal plus all the interest, whether it was incurred in 2009 or 2010. Okay, so your cash payment is $101,667. Okay, very similar to the last one. The only difference here is that the note went over year end, so we had to record a little bit of the expense, or actually a lot of the expense, in 2009. Now in January, we record the remaining interest expense and we close out the two payables. Okay, so if you're struggling with year end, remember that November 15th was the day that we signed it. It was due on January 14th. On December 31st, we had to record an adjusting entry. So the interest incurred, and this says 2012, and we were working on 2010. So if it was incurred in 2010, it must be recorded in 2010. So there's your interest expense and interest payable. Now in 2000, and we were working on 2010, if it was incurred in 2010, you have to separately record it. Okay, so all we're doing is recording the expense on the actual year that it was incurred. So we're separating that out with the December 31st year-end entry. Okay, so we're separating the two interest expense periods out. All right, warranties. This is one of those uncertainties. So you've all seen a warranty if you purchase, especially electronics, and I'm not talking about the extra warranty, but this is the manufacturer's warranty. So we've all seen warranties, okay, where I buy a product and there's a warranty. And in fact, I just did this. My son has an electronic device. I purchased it. I actually purchased the additional warranty with it. Now, I purchased it in December, and it right now is October, it's almost October. So it was a one-year warranty. We almost got through the year without claiming the warranty. And guess what? It broke, so now I'm sending it in for warranty. However, when a company sells warranties, oftentimes they're never collected, right? If I would have made it a couple more months, that warranty would have never gotten claimed. Okay? If it would have broken in December instead, that warranty would have passed. So companies know that when they sell warranties or when they give warranties, that sometimes the work is brought in and a lot of times it's not, right? A lot of times the product makes it that year or however many years. A lot of times it makes it with no warranty work. So GAAP rules say that you don't have to claim or you don't have to record warranty expense on every single sale, but you have to record a reasonable portion. If 5% of your warranties are claimed, you need to go ahead and accrue that 5% of warranties are going to result in an expense. Okay, and basically this is the same concept as Chapter 7, the bad debts. We recognize, as a company, we're going to have some warranty expense. And GAAP rules say that you have to apply matching principle here. Matching principles say that you have to record the expense in the same year as a sale. So if we record an sale here, we're selling equipment for $2,000 with a one-year warranty, then the company admits that, hey, warranty expense is usually 5% of sales. Okay, and it averages out because some customers will bring in warranties, others will not have a problem. So we can look at history. Companies do a really good job of that. We can look at history and say, okay, on average about 5% of items come back for warranty. Okay. So February 1st, the equipment is brought in for repairs under the warranty, requiring $100 in materials from the repair parts inventory. Prepare A, the journal entry to record the warranty related to the sale, and B, the entry to record the warranty repairs. So on October 1st, we would go ahead and record warranty expense. And again, we're recording the expense that we're expecting, okay, on this sale. So $2,000 times 5% is $100. An estimated warranty liability of $100. Okay? So we're basically filling up a bucket. Remember the bucket from chapter 7? It's the same idea. We're filling up this bucket, okay, waiting for the actual warranty to come in. We don't know who is going to bring in. We don't know who we're going to have to provide repair parts for. We don't know when it's going to happen, and we don't know how much those repair parts are actually going to come in at. But we're waiting with our bucket, and we're abiding by the matching principle that says we want to go ahead and record sales and expenses in the same year. Okay. On February 1st, when that comes in, we're going to debit this liability account. And it came in for exactly the $100. Okay, but that doesn't happen often. So we're going to close out this liability, and we're going to go ahead and record a decrease in repair parts inventory. This isn't an inventory account. We just put the repair parts on it. Okay. So at this point, we emptied our bucket, right? And they were exactly the same numbers, but that doesn't always happen. Now notice in the new year, February, we don't record expense because we recorded the expense in the old year, the same year as the sale. So now all we're doing is we're dumping out that liability account. And I think in your textbook, it's estimated warranty liability. So it's estimated warranty liability that we're increasing and decreasing. Okay. Now here's from your printout. On September 11th, a lawn outfitter sells a mower for $500 with a 1-year warranty that covers parts. Warranty expense is estimated at 5% of sales. On July 24th of the new year, the mower is brought in for repairs covered under the warranty, requiring $55 in materials taken from the repair parts inventory. Prepare A, the entry to record the warranty related to the sale, and B, the entry to record warranty repairs. Okay, you may want to pause the video and try it on your own, or you can just follow along. So September 11th, we need to record the warranty. What is warranty? It's an expense. So warranty expense, which would be 5% of the sales, or $25. Okay, so $500 times 5% would give you $25. And you're going to credit estimated warranty liability. It's called the liability, estimated warranty liability in your book. Okay, that's the bucket being filled up. We don't know who we're going to pay, but we know we need to record the expense in the same year as a sale. Okay, now come the new year, so this is now July of the new year, the repair came in. Okay, it required $55. We're not going to record expense, we're going to just pour out the bucket. Okay, so $55, and we're going to take it out of repair parts inventory. Now students always ask me here, well, what happened? We didn't have $55 in the bucket, right? We only had $25 in the bucket. But not really, because hopefully over that old year, you accrued a lot of money, right? Every sale that came in, you accrued $25. You filled up the bucket with $25. So hopefully your bucket has way more than $25 in it, right? And some customers will come in and you'll dump out a little, but other customers will never come in for that warranty work. Okay, so hopefully your bucket won't be negative, right? Because you've got multiple, every sale is going to accrue just a little bit of warranty in it. Okay. However, even if your bucket becomes negative, okay, even if this is the only sale and this is the only liability, you'll make up for that at the year end. Okay. In this particular example, though, just focus on what happened on September 11th. You record warranty expense and estimated warranty payable. In the new year on July 24th, oops, you paid out, and it was $55. Okay, so that's warranties. The other contingent liability that we're going to focus on is more like a lawsuit liability. They're called contingent liabilities because somebody has placed a lawsuit on you, and we don't know if anything's going to happen with it. So the first thing that you would do, and I actually worked as an auditor and had this, we actually did this, you send the claim to the attorney, or the attorney gets it as part of the claim. The attorney then will deem each of the claims, they'll look at each of the claims, and they will deem, is it probable, possible, or remote? Okay, they will deem whether or not each case is probable, possible, and remote. They will also tell you if there's a dollar amount attached to it. It's probable and we think we're gonna have to pay X. Or it's probable that you'll have to pay and we don't know how much. Okay? Or it's possible that you may have to pay and we know that it's possible you're gonna have to pay X dollars. Or, you know what, as your attorney, I think it's reasonably possible that you may have to pay, but I don't know how much. Or they could say, you know what, this is really a bad case. There's a very slight remote chance that you're going to have to pay this $1 million, or it's a very remote chance that you're going to have to pay, and we don't really know how much it's going to be yet. Okay, so these are the three distinctions: probable, possible, or remote. If it's probable and we know the amount, this means the attorney says, yeah, you're going to have to pay this. We're almost certain you're going to have to pay this, and here's the amount. You would officially record a journal entry. And we're not going to get into the journal entries here in this class, but just you have to know. Basically, you have to know how to handle it. So in this case, we would record a journal entry. If it's probable, meaning the attorney says you're probably going to have to pay this, but we don't know how much, you do have to record it as a note to the financial statements. This is full disclosure, okay? Meaning the people that are going to invest in your company or look at your company or financial statements have to know that this is going on. So we're going to note it, kind of like a footnote at the bottom of the financial statement saying, hey, users of these financial statements, it's written very nice and legally, but hey, users of the financial statements, there is a lawsuit pending. It's probable, the attorney's deemed it's probable that we're going to have to pay. We just don't know how much yet. Okay, if it's possible, it doesn't matter whether or not the attorney tells you the dollar amount or not, you still need to note it. Okay, and if the attorney deems that it's remote, you do nothing. Okay, so at a high level, the only time you're going to record a journal entry is if it's probable and you have a dollar amount. Otherwise, you're going to note it unless it's remote. In that case, you're going to ignore it. Okay, so here's an example from your workout sheet. The following legal claims exist for Mura Company. Identify the accounting treatment as either A, a liability that is recorded in a journal entry, or B, an item described in the notes. Okay, so A, Mura, the defendant, estimates that a pending lawsuit could result in damages of $1 million. It is reasonably possible. If it's possible, going back to our items here, doesn't matter if we know the dollar amount or not, we just note it. Okay, so if it's possible, note it. B, Mura faces a probable lawsuit on a pending lawsuit estimated at $500. Okay, here it's probable and we know the dollar amount, record a journal entry. C, Mura faces a probable loss on a pending lawsuit but cannot estimate the amount. It's probable, but we don't know the dollar amount, so we can't put it in a journal entry. So if it's probable plus we don't know, it goes into a note. And finally, D, Mura estimates that a pending lawsuit could result in damages of $10 million, but it's remote. Okay, it's remotely possible. If it's remote, you do nothing. Okay, even though it's the biggest lawsuit out here, if that attorney deems that it's remote, you do nothing. All right, so that's it for our ACC session. Please contact me or go to Harper's Tutoring Center in F315 if you have any questions. Remember to spend some time, especially this is the end of Unit 3, so the next ACC session that you'll listen to will be a test review. So make sure that you're spending time using flashcards or some other self-quizzing function to practice Chapter 9 concepts. All right, have a great day.